May we stand for the national anthem.
And the sing of Zambia, proud and free, land of wealth and joy in unity, victors in the struggle for the right. We want freedom's fight, oh, and strong and free. Africa is our own motherland, fashioned with and blessed by those who blend. Let us, oh, our people, join us one, brothers under the sun, oh, one, strong and free. One land and one nation is our cry. Dignity and peace meet Zambia's sky, like a noble eagle in its flight. Zambia, praise to thee, oh, one, strong and free. Praise be to God, praise be, bless our great Zambia, Zambia, Zambia. Green and we stand under the flag of our land. Zambia, praise to thee, oh, one, strong and free.
Thank you very much. We may remain standing for a prayer by Mr. Daniel Tonga, Manager, Strategic Communications.
Our God and our Father, we want to thank you this morning. We appreciate you, O God, for who you are and for what you are, O God, in our midst. We want to thank you, O God, even for this day, for this is the day that, Lord, you have made, and we're going to rejoice and be glad in it. Father, we want to thank you for this media briefing. We pray that, Lord, you may guide the proceedings of this briefing in Jesus' mighty name. We want to commit, oh God, the management, oh God, of Bank of Zambia into your hands, and that, Lord, may you guide them and lead them as they take us through in the name of Jesus Christ. We want to thank you, oh God, and we want to pray that, Lord, let everything that is going to happen in this place be that which is going to help promote and support the economic development of this country. In the mighty name of Jesus Christ, we pray with a lot of thanksgiving in our hearts. Amen.
Thank you very much, Daniel. We may be seated. Allow me to acknowledge the presence of the governor, the deputy governors, members of the Monetary Policy Committee, directors here present, members of the press, ladies and gentlemen, good morning. I welcome you to our third Monetary Policy press briefing for the year. As you may be aware, the committee met on Monday and Tuesday, and this morning the governor will be announcing the decision of the committee. As always, we are live on ZNBC TV1, Diamond TV, and the Bank of Zambia Facebook page. Special gratitude to Mwebantu Media, City TV, who are giving us live feeds, as well as Fan Voice Radio, that is giving us a live feed broadcasting into Central and the Copper Belt provinces. To our online audience, we acknowledge your presence. Thank you very much for joining us. We have on stage the governor, who is flanked by the two deputy governors. Deputy Governor in charge of operations, Dr. Francis Chipimo, on his right, and Deputy Governor in charge of administration, Mrs. Reka Chifue Mohango, on his left. Next to Mrs. Mohango, we have Director in charge of research, Dr. Jonathan Chipili. And next to Dr. Chipimo, we have Director in charge of financial stability, Mr. Goodson Kataya. Without wasting much of your time, I will at this point invite the governor to address the media. Governor.
Good morning. Let me join Bessie in welcoming you to this third media briefing by the MPC. Let me recognize the deputy governors, the members of the Monetary Policy Committee meeting. Let me start. Okay, as in our previous presentations, our presentation is into 7 parts. The first part, I will share the decision that the committee made, then embellish that with what we see as inflation outturn and how we see inflation over the next 8 quarters. Then look at the foreign exchange market, which has got a very close relationship to what happens to inflation, and look at gross international reserves, which also underpin some of the movements that we see in the foreign exchange market. Then look at credit developments, which are important in terms of driving economic activity, which is the next slide that I'll look at. How is the economy performing by way of economic activity, and then we conclude. At its August 11 to 12, 25 meeting, the Monetary Policy Committee decided to maintain the monetary policy rate at 14.5%. I heard Franklin rightly saying last time we did maintain the policy rate at the same level, and we gave a number of reasons for that. Equally, this time, we do have a number of factors that we took into account to arrive at that decision. First, since the last monetary policy meeting that we had in May, inflation has been on the downward trend, falling to 14.1% in June and further to 13% last month, July. 2, inflation is now also projected to fall within the target band from the first quarter of 2026, that's next year. Third, while recognizing these positive developments, the committee noted that at the current level that inflation is, at the current level of inflation, we note that it's well above the 6 to 8% target band. That's about 5 percentage points. And at the same time, we note some uncertainties that are stemming from the global trade policies that are being pursued, and then there are persistent geopolitical tensions. Fourth, the committee also observed that although market expectations of inflation have moderated, they remain high relative to the target band. I think we have in the past explained that we do survey the market on what they expect inflation to be, what they expect the exchange rate to be in the period ahead. What we have observed in that connection is that, yes, they are revising their expectations, but they are still quite elevated. The committee, therefore, decided to maintain the policy rate at 14.5%. The decision will also allow the consolidation of the gains that we have so far made on inflation. Let's drill down now into the details of some of these factors. Looking at inflation outlook, we noted that it has declined from 14.1% in June, from 16.5 in March, which is the end of last quarter. And this we show in the usual chart and table. So indeed, if you look at this table 1, which as always is divided in 2 parts, there is the upper part where we look at the average movements, and the bottom part where we look at the end period numbers. So what we observe, if we start with the upper part, overall inflation has come down from 16.7% to 15.3%, split into food and non-food. Food has dropped the most from 19.6 to 17.8%, and non-food has also come down to 11.8% from 12.7%. On end of period basis, inflation has come down from 16.5 at the end of March 2025 to 14.1% in June as indicated. Food inflation has also come down from 18.9 to 16.7, and non-food inflation from 13.2% to 10.3%. So this is the declining trend that we are talking about. So beyond the quarter, that's the July number, inflation was reported at 13%. The key drivers for this outturn were mainly three. First, improved supply of maize. I think we are all aware now that this year the harvest was a lot better than last year. In fact, this is the year when we have seen a bumper harvest in maize, surpassing all these other periods. I think the nearest was 1987, as we shared last time, when it was 3.2 million tons. Then B, lower fuel prices. You know that fuel prices have been declining, except this last month, the ERB maintained the petroleum prices at the same level. But you note in that statement that one of the drivers was the exchange rate, which had appreciated. Indeed, this is the third major factor that we are attributing the decline in inflation, which is the appreciation of the kwacha. We will come to that a little later to give you more details on that. Now, in terms of display charts, the two charts we have on the screen, on the left-hand side, we are talking of a food subgroup, and on the right-hand side is the non-food subgroup. What you see in both cases, if you cast your eyes to the very right, extreme right of this chart, you see what we are talking about, that the line is coming down. And then we look at the chart, the bar charts are also showing where this is coming from. So if you look, for example, the brown part, it has reduced quite substantially, notwithstanding that the blue side part has gone up. You will see the details in the, I have a bit of a challenge in spite of having double eyes to split that from this distance. So let me return to this chit chat here. So the blue line, the blue chart rather, there bar, is referring to sugar, jam, honey, chocolate, and also a combination, there's meat, the other one. So you see that has gone up slightly, but then the brown one, that's bread and the cereals. That's what has moved the most. And then at the top, you see there is that bluish, that's meat, I think, which has also come down slightly. On the non-food side, you see that also that the overall inflation has come down, but the factors there are you see the blue one there is to do with housing, water, electricity, gas, and the other fuels. Now, when we turn to the inflation outlook, this too has been on a decline trend, which shows that if I go to the table here, last time we met, we are saying that in 2025, inflation will average 13.8%. Now we are saying that actually it will average 13.4%. For 2026, we had projected that inflation would average 8.8%, which comes into single digit. This time around, that has strengthened to 7.7%. We couldn't have, obviously, the first quarter of 2027 because we measure over a period of 8 quarters. Now, bringing in the first quarter of 2027, we see that inflation will stay about the same in that quarter at 7.7%. This is significant movement because in both 2026 and 2027, it shows that inflation will be now in the target band, and that's what we are aiming for. But for now, we are saying that we are not quite there. That's why we maintained the policy rate at that level. In terms of graphs, if you look on the left-hand side, we showed two main lines there that may be of importance. The blue one, depending on, it's blue, I think, yes. The blue one, this is what we are now showing, which is the same information as on the table 2 there. But in graph terms, you see what we are saying, that the inflation will be in the target band, which is that brown patch there. In the previous period, we had shown that it was going to come down, but much later in the period. So what this is showing is that inflation now is coming into the target range much faster than we had projected. But those of you who follow this closely, you recall with us saying that the risks were tilted to this happening a lot earlier than was expected. So this is what is emerging here, that the risks are showing that, or the factors that we are taking into account in making those forecasts were showing that inflation could actually come much quickly to the target land than was at the time when we were making the forecast. Then what really drives these changes? Again, we are saying that the lower inflation is due to lagged effects of the appreciation in the exchange rate. What we observe is that the exchange rate applies in 2 main ways. One, there's the time when it is happening, there are immediate things that change. I think you sometimes see if it is appreciating, more so actually when it is depreciating, you see prices getting revised right there and then. But when it's appreciating, there is a slight lag in the agents in adjusting those prices. But in either case, there are those which move fast and those which lag. So that impact takes a bit of time to work through the system, and now this is what we are seeing that happening, that the exchange rate appreciation that was observed is now having a bearing on what inflation is right now. The other factor is, the obvious one, is lower food prices. Yes, we note that the FRA announced price for maize is much higher, but on the ground, the prices that people are paying for maize are lower than that. And that, when Zamstat goes to collect information, is picked up, and that's what shows in the numbers. Then we are also alive to the fact that energy prices have been coming down, and as I indicated last month, the ERB maintained the prices of petroleum products. Now, when we cast our eyes further, which will come when we are saying projections, we see that these oil prices, we expect them to be subdued They could go down, but they could also go up. But what we have seen over the past few months is that they remain subdued. Now, within copper prices being where they are, what we are saying is that the terms of trade are positive, and that has a positive bearing on the exchange rate that we see. The other matters that we took into account is that over all this period, let's start even from 2021, we have had a number of reforms that the government has been implementing. On our part, we have also been, apart from monetary policy rate that we announce here, we undertake a number of other structural measures. So all these combined have given us the result that we are seeing at that. So this is a combination of factors that have been going on. So even in the mining sector, when you are talking of increased production that is being observed, you have to link that to a large extent to the policy changes that have happened, which have enabled these companies to ramp up production. In fact, next week, His Excellency will be going to Kansanshi to commission S3 at the Kansanshi mine, which will double the production of copper by that mining. We were there last week, and we saw part of that effort which is going on equally at Kansanshi. So there's a lot that is going on in the economy, and when we put all these together, this is what is giving us these results. Obviously, there has been progress that is being made on the debt restructuring, the fiscal reforms. We are saying that the fiscal balance is much, much stronger now than had been the case. That said, we are saying that the risks to inflation remain tilted to the downside and mostly relate to the expected increased earnings from copper exports and subdued crude oil prices, which work through the exchange rate and expectations channels. In addition, we see that the progress on extended debt restructuring is expected to enhance relatively stable macroeconomic conditions and strengthen the inflation outlook. You recall that banks have been quite concerned about a non-movement in the core rating, the sovereign rating, because of the restructuring which hasn't been completed. So our expectation is that once this is completed, we may very well see a re-rating of the country, which will have its own positive impact on the economy. Now, moving to the foreign exchange market, what we see that in the second quarter, the kwacha appreciated by 14.4% against the US dollar, compared to a depreciation of 4% in the first quarter of this year. So on the right of the screen, you see this being depicted in the chart. We draw that line there, and you see what the first part, that is now the one we're talking about, the second quarter. You see what is happening to the exchange rate. It's appreciating very steadily, and this appreciation is attributed to increased foreign exchange supply, particularly from the mining sector, as well as improved investor sentiments and the weaker US dollar on the global market. So many of the countries, including ourselves, are benefiting from that movement in the dollar. With the reduced volatility during the period under review, our support to the market also reduced. The bank moderated the support to $171.5 million from $234 million in the previous quarter. But where is this money coming? As I indicated, this is coming mainly from the mines, and we show that the supply from the mining sector increased by 22.1% to 680.1 million in the period under review. This is depicted in the chart on the right. You can see the bars are rising steadily, going up. Now, of this amount, $262.1 million was limited directly to the Bank of Zambia for tax obligations. So this has helped us to accumulate more reserves. And the one in anticipating a question which might come is this sustainable? Well, what we are saying is that as long as there is increased supply of foreign exchange and the demand remain met, we should see continued strengthening or stability of the kwacha. So our focus is not so much on the rate of the kwacha to the US dollar, but the volatility that underlies that. That's what prompts us to enter into the market so that we reduce that volatility. And the other thing which perhaps is not quite obvious is that during this month, we have, alongside what I say that our presence in the market was reduced, we haven't had that need to do that because volatility has reduced. Then moving on to the other aspect of the foreign exchange market, this relates to the supply. What we see here, what we are saying is that excess demand reduced substantially to $156 million from $257 million in the first quarter. So that's quite a significant movement, because without that, you could have seen more volatility, and then the exchange rate could also have been depreciating. So the appreciation that we are seeing also is linked to this reduction in excess demand. Gross international reserves also increased to $4.7 billion, which represents 4.6 months of import cover. Just to stress that the import cover that we are referring to here is prospective imports, not the past, but what we are foreseeing to be the imports in the period ahead. So in terms of months of import cover, the value may be different, but when you divide those two numbers, you still come back to 4.6 months of import cover. I think it's important here to point out as well that those of you who have had access, which is on the web, the report, the IMF report on the fifth review of the ECF, this is the extended credit facility that we have with them. You note their observation on our accumulation of reserves, that in comparison to similarly placed countries, we are actually doing a lot better in that space. But obviously, we have to be mindful of the fact that next year, we have quite large maturities in the non-resident holdings of government securities. So we have to navigate that carefully so that we don't end up with a situation where the reserves that we have accumulated end up being eaten up by that. The other contributors to this increase in foreign reserves is the statutory reserve deposits that we hold for the banks. what happens is that you remember the statutory reserve ratio stands at 26%. So part of that is in foreign currency. So we hold that as part of our gross reserves in the central bank. Now the banks do have access to these until their period of observation. They can access this, but sometimes they don't resort to getting them. During the second quarter, we noted that we bought additional gold to the tune of 77.76 kilograms at a market value of $8.2 million. But it's important that to point out that this we pay in kwacha. That's the only way for us it can make good sense to pay in kwacha. Because if we are to pay in foreign currency, then we'll be chopping away. In other words, we'll be moving from one reserve asset to another, so there's no additionality. So to have additionality, we have to buy in our local currency. Then that's a real addition to our gold holdings. So with that purchase, the total amount of the gold we have has increased, which have now risen in value terms to $315 million, $315.8 million. Credit developments. This is where I think the story is a bit different, but still in the positive range. What we are saying is that overall domestic credit growth edged downwards to 12.7% year on year from 15.3% in March. So this is shown on the chart on the right-hand side. So here there are two main contenders. The blue, that's what goes to the government, and the red one or orange is what represents the private sector. So what we are saying is that the private sector credit growth in nominal terms slowed down to 19.8% from 23% due to marginal reduction in lending to the manufacturing, construction, wholesale and retail trade, and real estate sectors. So this is an area where we are watching, because these are also areas which we would expect or want to be contributing to the overall growth of the economy. So if credit is slowing, this then something that we are concerned about and take measures as we see appropriate. Now, lending to government declined. This decline was on account of reduced demand for treasury bills and bonds, reflecting lower liquidity levels. In other words, there were not much liquidity levels, so people could not buy more treasury bills and bonds. But I must say that at an individual level, we have seen quite a lot of people participating in this. We see when we are at the show here at the trade fair at our stand, one of the most visited section in our stand is participation in government securities. So we encourage people to do that, because that's a form of saving, but you are also contributing to the resources that the government needs for the many things that we are demanding. I think whenever you hear Boma Yanganepo, it needs money. So it means it has to get it from somewhere. Now, total outstanding government securities stood at 239.57 billion kwacha at end July. Out of these, non-resident holdings are standing at 61.22 billion kwacha, or in the proportion terms, 25.5%. So about a quarter of our outstanding government securities are held by non-residents. Turning to economic activity, we are saying that there was continued improvement in the second quarter as business conditions for the private sector were assessed to be favorable, as reviewed by the Stanbic Zambia Purchasing Managers Index. This is the spiderweb, the chart there on the right-hand side of the screen. The way to read it, if you look the red, this is what was the representation in the first quarter. So now this greenish blue, that's what is the case in the second quarter. You can see it's larger. So the larger or the closer you get to the outer web, the better the economic setting. That's what this shows. So where there are those corners, those are the areas where the measurement is taken. So you have a chance to dissect this further to see which areas did better in the second quarter. But the general information is that there was improved economic activity during the quarter under review. On our side, we also do undertake a quarterly survey of business opinions and expectations. This too indicated that there is a pickup in activity which is underpinned by stronger agricultural output. Further, we see that in the medium term, which is the outlook, the prospects for domestic economic growth remain positive. So on the right side of the screen, we are showing that there are different groups that do take time to forecast what GDP growth would be. So there are 4 there that we are reflecting, including ourselves, and in all the cases, we are showing that there is a positive outlook. GDP will grow. The difference arises from how one makes the assumptions, what would be the drivers of that, and how strong those drivers would be. But the general thrust is that the economic growth is on the positive trajectory. Yes, you may say that it's not as strong as we would want to be, but it's positive, and that's very, very important. And some of the drivers of that are mining, agriculture, ICT, as well wholesale and retail trader. So these are the sectors in the outlook that we see to be driving this growth that we are reporting. Then, coming now to conclude, what we are saying that the committee decided to maintain the monetary policy rate at 14.5%. Why? Because we are saying that from the last meeting that we had, inflation has been on a downward trend, which has fallen now to 13% in July. We are also saying that the projections which we have shown are showing that inflation is likely or is due to return to the target band by the first quarter of 2026. But the committee was also mindful that there are other things that are still going on, so we shouldn't prematurely start winding down the tightening that we had done. So we have to allow the system to consolidate the gains that we have so far made on inflation. So we are saying that where inflation is at the moment is still outside the target band. So we need to give it time to see how these factors work themselves out so that we get comfortable that inflation is indeed well within the target band. We are also mindful that there's a number of uncertainties out in the global world. There's every day you are hearing the story information about, and besides you are the people who cover that information about tariff being slapped on this country is retaliating. So all these have impact on people's ways of life. So that results in people not doing certain things that they would otherwise have done. Then there are issues of geopolitical tensions. We hear all these bombings and the hostage taking. All these have influence on how people move and how goods and services also operate. So given that, we felt that it was important not to rush into making these changes. Equally important, we are continuing to anchor these inflation expectations. They are taming down, they are getting tamed, but people still have some expectation that inflation could be high. So we need to work through with the system so that we don't get inflation rising again. The committee therefore decided to maintain the policy rate at 14.5%, and this decision will also help consolidate the gains that we have so far made on inflation. Thank you, and God bless.
Thank you very much, Governor. So there you have it. The MPR has been maintained at 14.5%. We are now going into the question and answer session. Please ask one question so we give chance to as many people as possible. And if you have more than one question, we can take your second, third question after we have given everybody an opportunity. So if you have a question, please walk through to the backdrop that is on my left-hand side. State your name and the institution you represent, then proceed to ask your question.
Good afternoon to all the committee. My name is Ketra Kalunga from Times of Zambia. My question is on the old bank notes. So I wanted to find out how much notes in terms of percentage have been withdrawn from circulation. And I also wanted to find out whether the bank is on course to produce the 50 kwacha and 100 kwacha notes by September, as earlier indicated.
Good afternoon, Governor. My name is Cecilia Chiluba from Money FM. I would like to find out how the central bank assesses the effectiveness of previous monetary policy decisions on inflation and exchange rate stability.
Good afternoon, Governor, and good afternoon, everyone. My name is Justin Perry from Zambian Business Times. So just last week, we saw the Bank of Zambia and FQM renewed the gold purchase and delivery agreement. So I just want to find out from you what volumes and value of gold are you projecting to add to the reserves from each of the 3 years contracted term. Then my second question is, we've seen that inflation is currently around 13%, yet the public sector wage growth is below 7%, with the cost of living believed to be growing faster than the income. My question is, do you believe the current, your current stance is protecting the price stability for households, and or is it not just focusing on reducing inflation back to the single-digit number, which is the 6 to 8 target band? Thank you.
Okay, thank you very much. I'll get some help on the issue of notes withdrawn But on the issuance of the 50 and the 100 kwacha notes, we will make an announcement before the end of this meeting. Yes, we are on course. Okay. So maybe Dijo Angela, where is she? Can you help?
Thank you, Governor, and good morning, everyone. So we've withdrawn 9.9 billion of the odd currency, and this translates to 44.3%. Thank you.
The other question, how does the Bank of Zambia assess the effectiveness of monetary policy? That's a very technical question. I don't know if you want us to go into the details of that, but there are variables that we look at in a high-level fashion. One of them is, see, inflation is in two parts, right? There's non-food and food. So more related to what we do is the non-food. That's why when food is the driver of inflation, we have always said that there are challenges because that's a supply side issue. But the way monetary policy works is through aggregate demand. The policy rate that we are announcing is designed to, if we raise it, it means that we are contracting the growth of credit. In the time when we used to use monetary aggregates, it means that we are reducing money supply into the economy so that people don't buy as much. Because inflation, one description of it or definition is, say, that is a money phenomena, meaning too much money chasing too few goods. Now, in the current setting, it's more of credit provision, which is the issue. So when the policy rate goes up, it means that the cost of borrowing goes up. So that's one way you can measure. The other tools that we use had to do with the liquidity arrangements in the economy. For example, in the foreign exchange market, for you to buy a dollar, to buy a euro, you need a kwacha. There will be an exchange of kwacha and the foreign currency. That's what the exchange rate is anyway. So what we do then is to make it harder if there is pressure on the exchange rate to depreciate for you to get that money. So we typically use the statutory reserve ratio to do that. And then you look at the outcome, which is where the exchange rate has moved. So there is a whole range of things. I don't know if that helps to shed light on how we do that, but there are all these technical mechanisms that we do. Then maybe Dijo, you want to add something?
Not really, Governor. I mean, it's a very important question. I think just maybe what I would add to what you have said is, because this is something we think a lot about. I mean, the Governor has talked about the different channels through which our policy affects inflation. So the exchange rate channel is explained, the interest rate channel affecting credit is explained. There's also something we ourselves want to have a better assessment of how monetary policy impacts not only inflation but the economy. And so in our strategic plan for 2024 to 7, I think it is, one of the things we've embarked upon is to actually do a big survey of companies and households to actually have a determination of tracking them. How are they being impacted by the policies which are taken? And we hope that once we set this up, we'll then have an avenue by which we can actually test how the policy impacts actual businesses and households. So that's something which we've put in our strategic plan, and it's something which the team in research are working on in terms of getting the survey set up. I think that will give us another basis in which we can actually test in an empirical way how is the economy being impacted. So maybe that's what I would add. Thank you, Governor.
Thank you very much. Then, Justin, the agreement or the contract that we signed with the Kansanshi, you want to know how the volume of the gold that we are buying. First, I think it will set the context correct. Kansanshi Mine is a copper mining company, but gold also is produced in the process. So you see, like, it comes together with the gold. What we appreciated when we visited is that for a ton of copper that they produce, they may realize something like 62 grams of gold. So it's not that gold, they are gold mining company. So it's a byproduct of that whole process. So the quantities, therefore, are not as large as you would expect if it was strictly a gold mining company. So from that perspective, our contract is structured in such a way that we can buy as much gold as they need kwacha for. What does that mean? Let me unpack. Because we are buying gold, like I said, in kwacha, the seller must have the use for the kwacha that they are realizing from the sale. So they will assess their kwacha needs and the amount of gold that they have produced, and will sell to us what they deem will be consistent with their kwacha needs. So on our part, we have no limit. We can buy as much gold as they are able to provide. So this is why this program is being expanded to other gold producers, so that we increase the sources of supply, including the artisanal mining, once that arrangement is completed. Because the way it is, you cannot just buy. See, these artisanal miners, what they have is unrefined gold. What we are buying from Kansanshi is refined gold. So what happens is that when they collect its small particles, then they melt that, refine that, but that is still not monetary gold. It still has to go for further refining to get to monetary gold standard. So that process is witnessed by a number of agents. ZRA, Zambia Air Force, because they have to fly those out, the police, all these agents. Those going, I saw some of you in Kansanshi. I'm sure they can share their experience, because that was explained very clearly that there are all these agencies which witness the shipment of that. So when it is refined by Rand Refinery in South Africa, then that's when we get the portion, and we continually value it. Because if we bought the unrefined gold, it means that we have to arrange also logistics to get it refined. So we are not in that space as an institution. There are institutions which can do that. So what we are trying to do with the government is to organize this segment of the market so that there is gold refining, and then we can buy as an off-taker. So I hope that answers your question. You asked another question, which is, I think it's straying into another area, which is labor matters. I don't know, as we focus on monetary policy, So when you are saying that the inflation is 13% and then the wage award is at 7%, what does that mean? Well, there's a gap, obviously, but the thing is that there are many reasons why the award is that way, because you have to look also at your ability to pay. You can't just agree to a higher increment if you can't pay, because then it defeats the whole purpose. But as I said, I think that particular question could be best answered by those who are doing that. So for us as an institution which is charged with the responsibility of maintaining inflation, we also watch that very carefully, because we don't want that to be a demonstration effect. Because if we are all chasing inflation, then it will be like a dog chasing his tail. We increase the wages, then prices go, inflation keep going up, and then we end up all losing. Why do we focus on inflation? We focus on that because it's like a thief in the night. Your purchasing power is eroded even if you without doing anything. But obviously, wage increases cannot always match the increase in inflation, because the capacity or the ability to pay comes in. Then you are saying that when we are focusing on inflation, but we are perhaps not looking at the impact on the households. Well, it depends on how you are looking at it. Because what is inflation? I think we have explained this time and again, but perhaps it doesn't hurt to do so again. You see, inflation is the rate of change in the prices. Okay? So it's not the same thing as the relative price of, say, maize. You know? Now, when prices rise, that's why we show you those charts to see that there are different components that contribute to this basket. So some prices would be increasing, others would be decreasing. So on average, we'll see that perhaps the rate of increase is slowing. That's when we say that inflation is coming down. But if prices have risen, for example, the FRA price of maize is at 340 kwacha per 50 kg bag. So if that remains, that it doesn't follow that because we have said the inflation has come down, that is also changing. No. This is now where you are talking about the cost of living, that you are still going to pay at that high. I think we have explained in this forum that there are countries which have next to zero inflation, but the cost of living is still very high. Why? Because the prices of individual commodities are still high. But I see why you are bringing it, you linked it to the wage increase and all that, is to address the cost of living. Also, you have to increase the earnings of the people so that you cushion that. But you have to put this in context. You have to have the capacity to do that. If you don't have the capacity, you'll be just cheating each other that, no, I can do this. When it comes down to doing it, you are not able to do it. Then you get frustration and people will come calling each other names that, no, you are lying. You said you are going to give me this and not that give me. So you have to be very careful how you do that. The other thing to be mindful about, you see, prices of commodities other than labor, they change frequently. They can come down. I'm sure you have seen the fuel prices, they come down. But imagine you are given a wage increase. Now, because inflation and other things have come down, they say, no, let's cut your wage. Would you agree? It's a war, you know? So that's why you have to be careful, because they are resistant to reduction when these circumstances change. We have seen companies which are in the export sector, for example, when the exchange rate is depreciating, they get more in terms of the kwacha, and then it becomes celebration time. You can buy. Right now, actually, we are hearing some people who are earning in foreign currency. No. The appreciation of the kwacha is hurting us, because before they used to get more for each dollar that they exchanged. But there were others who were on the other side who were facing the brand. So that's why for us, we are indifferent to this, because we have to just make sure that we try to get this down so that everybody benefits. So if you are in export business, don't rush to awarding yourself a high pay, because when the other thing comes, which is appreciation, you start crying that, no, I can't meet it. And we have seen companies go under because of that. I think those were the questions. Thank you.
Thank you, Governor. So we only have 20 minutes for this segment, after which we'll allow the Governor to come and make an announcement on a different issue. We can have one from yourself, then we'll take from the online audience, and then if we do have time, we can take the last round. But let's be quick, if we can.
Good afternoon, Governor. Taonga from Bloomberg. I basically wanted a clarification on table 2 with regards to inflation outlook. The slide was showing 13.4% inflation outlook for 2025. However, the very next slide shows 13.3. So which is which between the two?
Thank you very much. Sinkala Suilanji is asking Governor that the monetary policy transmission in Zambia is often cited as slow due to structural issues in the banking sector. What concrete steps is the Bank of Zambia taking to ensure that changes in the policy rate quickly influence lending rates, credit availability, and inflation expectations? Agrippa Kasanga is asking, has the Bank of Zambia considered the impact of climate change on agricultural output when setting the monetary policy rate? And are there targeted policies to support affected sectors? On government securities, we have Memory Simwamba asking, why are we increasing tax on yields for government securities when indeed the reduced yields have led to reduced uptake by investors? A similar question came from Chichi, who wants to find out who's saying that with the reduced participation in government securities and the withholding tax at 20%, is Bank of Zambia able to look at a seemingly low interest rates?
I think we may have missed that. I think rounding up would have been the issue. The rounding up of the figures. We can fix that, but it's in the same range. We may have picked the other one, and because it's not to, this is to 1 decimal point thing, so that could be the roads, but we can give you more insight to that. Thank you for being observant. Okay. On the changes in the policy rate and why doesn't it move quickly to affect those? Perhaps one of the ways, I think Tijo touched on this, that we are trying to look at the transmission mechanism on how what we do impacts this. Now, here's the situation. When we raise the policy rate, what happens? We are not in direct interface with the market participants. We work through intermediaries, financial intermediaries, which are the banks and the financial institutions. So these have their own ways by which they grant credit. It's not just the policy rate that they consider their profit margins and all that. Now, we are behind the scenes, obviously, interrogating how they arrive at their rates. But one of the things you have been hearing us over the years, I'm sure, calling about efficient management of cash by the government. I think you have infamous, you have the treasury single account. All these are trying to address the issue of cash management. Why? Because when we are using the policy rate, what we are targeting is the interbank rate. The interbank rate, this is the rate at which banks lend to each other. Now, the banks lend to each other more leniently than that because we are dealing with wholesale funds. Further than that, why we are doing this is that we want banks to be more reliant on wholesale money. The wholesale money is the money which comes from the central bank. But if you have leakages, which is like not good management of cash management by government. You remember last year, was it February, when we tried to round up the deposits, unutilized deposits of government in commercial banks. It brought a lot of uproar because banks saw that they are losing that lever that they had, the float holding on to that money. But what that was intended to do was to precisely strengthen the impulses that, or the influence that the policy rate has on the behavior of banks. So when you have noise around the system, then you find that your rate doesn't have the same impact. The other thing to consider, we no longer present it in the monetary policy statement here, but you find it in the report, the monetary policy report that we did. We show you where the interest rates are, the lending rate. We show you where the government securities rate for the treasury bills and all that. You see that most of these come down. But there was a time when the government securities rates were so high, and it gave no incentive to one who is in the financial system to lend to an individual who poses risks. Because if you lend to the government, you can actually go on vacation and just wait for that time for your instrument when it will mature or when you get your coupon rate. So part of the message has been to manage the fiscal better. And this is happening, and that's one of the reasons why the yield rates or the interest rates which are on government securities are coming down. So it's a process. It doesn't happen immediately. For example, if today we had raised the policy rate, tomorrow or even this afternoon, you will see that the banks will raise those rates which they say are linked to the policy rate. That happens. Equally, when we reduce, but sometimes there is a bit of reluctance to immediately do that because there are certain things which are affected in so doing because they had projected a certain earnings, and then when this happens, they have to go back and calculate. I'm sure you have seen it even on fuel, that nowadays what we see is that people, when they are expecting that maybe the price is going to go down, maybe they don't act quickly. That has happened. So these are some of the asymmetries that we see in the market. So the idea is that we try to smoothen this whole process. That's why we are going into automation and all that, so that the flow is much, much more quickly. But it's not that straightforward because we go through intermediaries. Now, if you look, because you asked what do we do to help I think this is the next question. This SRF, that's precisely to do with the impact of the drought that we had. There it's very linked directly to the policy rate. So what we are saying that if you are going to do a green project, which we deem as green, we actually give you 300 basis points with 3 percentage point reduction in what you get from the policy rate. And if we raise the policy rate, we don't raise the cost as well. But if we reduce the policy rate, you get it at that level. Why? Because we are trying to help those who are in that situation. So we are not directly as an institution in the real sector, but we do participate in some of these facilities. So the policies are there, the green policies, we participate in government things. So there is a whole range of things which are doing. Now, memory, when you, maybe Dijo, you can help this, reduced participation and withholding tax.
Thank you, Governor. So I think two things here. One, partly relating to what the governor said about fiscal policy and even this complaint about the cost of credit. Government securities obviously are, as governor has mentioned, a risk-free instrument. And so in some sense, the commercial banks, one of the things they'll do is make that determination of if I lend to government, as governor has said, relative to lending to you. So that will become like a benchmark. So a lot of the work which has been going on the fiscal policy, on us reducing inflation, is to try and get that rate down. That is overall good for the government, means they're borrowing at a cheaper rate. It's good for the market in the sense in which it means that we can have lower lending rates to the businesses and households who ultimately are the ones who build the economy. So you have to first take that point that just because yield rates are coming down is not a bad thing. But the point really I think you're raising is that two things which I think I say. One is the direction. Is it bad for people's participation in government securities? Again, if you look at where the yield rates are, I think the top one now is around 20%. The 2-year maybe in the low teens. So if you look at that and look at what you can get if you put your money in a bank, that yield rate is still significantly above that. And so it's still an important proposition for people who have money to save to lend in a way in which it's an instrument which is secure and you will be paid. So the fact that it's coming down doesn't mean that the incentive for people to come into that market has gone away. In fact, we are continuing to promote investment at the retail sector in government securities. We send teams all around the country, and we hope that that is going to create a more stable funding actually for the government. So I think there's a win-win there. The second is on the tax. And of course, it's true that the increase in the yield rates means you get a less return. And so in that sense, there's a disincentive for you to invest. But remember the first thing I've said, that for you, you still ultimately have to make the determination, even with this reduced yield, which I'll be getting, is it still better for me to invest in this instrument or not in terms of my overall savings? We think it is. The basic point about why it was introduced is really a fiscal policy issue. And I think Governor has mentioned that when you look at fiscal policy, just like we were talking about wages, you have to take all of the things which the government is trying to do in the round. And all of these things ultimately for the government is, they were really trying to say, can we continue the path we've been on of reducing the fiscal deficit with all the positive benefits which that has for the economy, which Governor had indicated in his presentation. So, broadly, we don't think this will reduce participation per se. I think you shouldn't confuse it with, Governor had mentioned the commercial bank's participation, and it's important just to clarify that when we look at government securities, so there are two buckets. Essentially, there are the treasury bills, which are the shorter term up to 1 year, and then there's the government bonds, which are longer, 2 to 15. You generally find that the commercial banks are the key participants in the treasury bill market, whereas in the bonds is where you have now the pension funds and others. And so the dynamics with these two changes sometimes. So if, for example, as happened in 2024 when we raised the statutory reserve ratio quite aggressively and liquidity was tightened, you saw people coming out of particularly the commercial banks, the treasury bill market. And likewise, when things eased, that changed. So I think you also have to be aware of the dynamics of those two markets. It doesn't mean that all of a sudden people won't be investing in government securities. So maybe that's what I would clarify. And on the climate change, I think you've clarified.
Thank you very much. So at this point, I will invite the governor to make an announcement on a different issue. And if we'll have a few minutes thereafter, we will continue.
Thank you very much, Bessie. I think I answered the question which was raised, where we on course on issuing the 50 kwacha and the 100 kwacha notes. Yes, we are. And we are issuing this public notice on that very issue. We have done all the preparations. We have the notes. They have been distributed throughout the countries, through our channels. So come 1st of September, you can access the 50 kwacha and the 100 kwacha notes. We have also developed an app which is available for those who are on Android. It's also there. Those who are using iPhone, iOS, is also there. So you can access this by going to these platforms by searching Zambian banknotes. You see a Bank of Zambia logo, which will bring out this, and you can navigate that, which will give you an opportunity to look at the different features which are on the notes, more so the security features. You'll be surprised, some of you who haven't taken the time to look at the physical note, or you may not even have the apparatus to actually see the details. There is quite a lot of detail on each of the notes. So once we start issuing that on 1st September, consistent with the SI that the minister signed, there's instrument number 9, which the minister signed, which showed the withdrawal. When that happens, we will no longer reissuing the 50 kwacha and the 100 kwacha, just as we are not reissuing the other denominations now. So when they are surrendered, that's it. Until next year in March, we'll still be using those, but will not give back those notes. Once they come, they are collector's item. So please, we'll post this on our website. It's a public notice which will go out today, specifying what I've just said. So yes, we are issuing the new 50 and 100 kwacha notes beginning the 1st of September. Thank you.
Thank you very much, Governor. So the app is designed to augment public awareness and understanding of the features of the new currency. We can go back to the last round. I'll start with Munyumba. I know that he was waiting. Munyumba, and then we can have 2 more.
Hello, good morning. My name is Munyumba Mutwale. I'm from the Business Telegraph. Just following up on the question regarding the proposed taxes, not just specifically only to the government securities, but even just the proposed tax hikes that were now coming in order for fiscal rebalancing. I think some of the views we were starting to get, and I know this is a bit of a split one, was that we're starting to get that it might bring some inflationary pressure back into the economy, especially in the spirit section, the ones that were being targeted, the areas that were being targeted, those were more sin sections, like sin products of the economy. Wouldn't we see that having a little bit of of an inflation risk coming back, especially with these companies trying to protect their margins? And also in the same light of the same taxes, even when it come back to government securities, we did see in the very next auction, interest rates started coming up. Almost like there was a retaliation from the market to say, look, if you're going to tax us, then we'll just get it back in higher interest rates. Do we not see this also having an impact on yields and lending on bond yields, which have been coming down, potentially now pushing back upwards as people trying to recoup their potential tax losses? Thank you.
My name is Rachel Mumba from Diamond TV. My question is on, the 1 kwacha, 2 kwacha, and 5 kwacha coins. Governor, these denominations were introduced to deal with the mutilation for the high velocity lower denominations, but we have not really seen these lower denominations, especially the 2 kwacha and the 5 kwacha. Is there anything that the bank is doing to make sure that there's enough of these lower denominations available to the public? Thank you.
Good afternoon, Governor. My name is Roland Kalango from Hot FM. My question is on the monetary policy rate. I saw that we have been on 14.5 February, May, and now. But looking at the factors that we have highlighted, to begin with, inflation 16.5 to now 13.0. And then you increase supply in maize, a lowering of fuel, maybe due to open access framework. All these factors, apart from the instability on geopolitical, that's the major thing that I saw from that angle. Don't you think that it was high time that the monetary policy rate reduced so that it could favor the MSMEs and the SMEs, especially when it comes to soft loans and the likes, so that it translates into the growth of the GDP?
Thank you. In the interest of time, we'll take the last one.
Thank you, Prudence from Diamond TV. Governor, I noted when you made your presentation on private sector credit growth, we recorded a reduction to 19.8%. I know the reduction might seem minimal, but when you went to the other presentation, you equally indicated that in terms of growth, the same institutions that showed a reduced reduction, like the manufacturing sector, wholesale, retail, these are the same sectors at the same time that you're expecting to contribute to the growth. So this is the sector whose growth is reducing. At the same time, these are the sectors you're predicting to contribute to the growth of the economy. Don't you think the reduction in the lending by this sector is as a result of increased lending rates, which is, of course, 14.5%? Don't you think after 2 years of tightening liquidity, it's high time we started looking at liquidity cost reducing? Thank you.
Thank you. I think, Governor, you may take those questions.
Thank you very much. I think the Munyumba, the very interesting scenario you laid out there, for sure. The thing is that in life there are trade-offs. So you are here now, you have made a decision that you forgo something else. So in all these policy measures that we take, there are trade-offs, but you expect that there will be an upside to what you are doing to compensate for that loss that you may incur. So when these taxes are raised, we must look at what is the reasoning behind. Now, we have had a situation where the fiscal situation was out of control. We ended up being defaulters. It is very painful. I don't know about you, but for some of us, when we go, that each time the people refer to Zambia, say, oh, the country which defaulted under the COVID. The first is that label is like it's etched on our foreheads, you know. That's very painful. But why did we get to that? It's because we didn't manage our fiscals prudently. So, in now navigating back to get their economy back, we, for example, asked for the help of outside players, notably the IMF, to come with the ECF. But to get to debt sustainability, we have to get our debt service to export in a certain way. We have to get our debt to revenue ratio in a certain way. We have two big, I think I explained last time, two big landing zones. One is the debt to revenue, which must be about 14%. Then we have the other one, which is debt service to export. Debt. So the other one is debt service to revenue. The other one is debt to export. Should be about 84. Now, what does that mean? What it means for the revenue side, we have always to push revenue up. Because if it comes down, it means that now again we are knocking on the door of being debt unsustainable. So this is why the government is looking for ways to keep that ratio up until we get out of that constraint that we are having. So that means making very hard decisions, which of the type that we are talking about. So it's intended for that purpose, so that our debt position gets better. Now, how would we really get out of this? Is obviously to get growth going, which is what is happening, where people are saying we are in recession or no. So we need to get a growth upwards of 10% or 7% for a consistent period of time. Then we'll start all moving forward. Now, people will complain that, no, you are talking of debt, but where is this being felt? It takes time for that to permeate to the rest of the economy. That we have growth is positive, but to start now agitating like others are saying that, no, but you need to redistribute. What will you distribute? You don't have. You can't redistribute poverty. No one would want to get poverty redistributed, isn't it? So these are very difficult choices that have to be made, but the idea is that in so doing, we'll get the economy moving and we'll get out of this and be able to have higher levels of living. So these are the complex balancing that we have to make on a daily basis. The question, so the yields we are talking about, yes, people may do that, but it will have also short-term end. It may increase inflation like you are saying, but this is why not one tool is sufficient to get you out of what you are facing. This is why we are working, for example, to come back with a development institution. We are urging also people to go for these outside funds. This is why the government also is going into PPP, is to use other resources other than the budget resources to get some of these activities going on. So some of these players we are talking about, they have borrowed money outside, not within, and it's on their balance sheet. So for example, you take Kansanshi, they are employing in excess of, at steady state, 11,000 employees. At peak of their thing, they are talking about 14,000 employees. So that's a plus. You go to Kalumbila, they are also employing in excess of 9,000 people. But they got money from outside, which augments the resources that we have here to get things going. So when now those people are employed, they are paying the taxes, they help to meet some of those requirements. So we have to look a whole policy mix, not just one. If we look at one, it certainly won't do. There's no one policy which is a silver bullet to resolve our problems. Then, Rachel, you asked about the 1 kwacha, 2 kwacha, 5. We have plenty of those. I don't know why there should be a shortage. Just last week, some of you are observant. You may have seen huge trucks, which we are bringing in more of those coins. So we have a lot of those. We don't have that. So please direct us to those areas where you see those are not available. Then we'll talk to the institutions and the bankers for those so that these are made available. We have lots of those coins. They are not an issue at the moment. Then, Roland, I thought we answered that question, but it looks like we didn't manage to say that why are we holding the policy rate at the same since February this year? There are still risks that we must manage. See, part of the forward-looking framework is really to give you a snapshot into the future, right? So what we are seeing as happening hasn't yet happened, right? The inflation is at 13%. Yes, it has come down from the height of 16.7%. But remember, our target is still 6 to 8%. So we are not yet into that target band. We are 5 percentage points above that. So we have to manage this. Otherwise, like I said, if we prematurely start unwinding, we could get back up in a vengeful way, which again you say, why did you do this? So even when you are driving, if you are a driver, when you are high speed, you don't just slam the brakes, right? You observe the road condition and gently brake unless it's an emergency. So this is what we are trying to do. We are observing and pushing these other things. At the right time, we'll begin to do that. We had done that in the previous times when the circumstances warranted. So we are looking at things that you may not have seen, but they could hurt us if we don't plan for them properly. So this is what a caution that we are taking to assess what is happening in the entire environment, because inflation is still double digits and it's 5 percentage points above our target range. So maybe if it was 10, you may argue, say, no, but you guys know this. But we are still 13 and it's still moving. And remember too, the period we are going on also there's seasonalities, right? The maize harvest happened already, right? So agricultural commodities are being sold. Some of them are already now finishing. So what happens? Until next year, that's when we will produce. So there are all these things that we must take account of. So I hope that helps you to, maybe you read the statement. We are trying to explain that, but if you are still not satisfied, we invite you for a offline conversation. Prudence on the private sector. You know, this is again comes to the issues of the trade-offs that we are talking about. Yes, the thing is that this has that effect, but we are also mindful that if we don't do what we are doing, if the macro stability is not sustained, you are going to have worse situation. So, which comes first? Often, all countries which reform successfully, macroeconomic stability is a prerequisite. You build on that. So we are just getting a macro stability, but we are still not within the range of those variables that assure us that we are on a solid footing going forward. So until we get to that, we have to be mindful that these trade-offs have to be exercised very judiciously so that we are able to manage the economy in a manner that will bring the benefits that we are all expecting. So it's not immediate. Some of these things have medium-term to long-term impact. So sometimes we tend to over-focus on the short term and forget about the thing. Because some of the things that we are seeing here are decisions of some time back. That's when they are coming to. Some of you went to, I'm sure maybe some of your colleagues were laughing, so why are you going to school doing journalism? What is this? But now that you are a journalist and you become accomplished, people said, I should have done that. But you had the foresight so that you invested that time ahead, but someone else did not, and then you are in different positions. So that's the issue here, is a trade-off. Every decision that you made, there is a trade-off that we have to exercise. Do you err in the point of caution, or you become exuberant and then you regret later? That's what we are trying to avoid. I hope that helps.
Thank you very much, Governor. So with that, we have come to the end of our briefing this afternoon. So allow me to say thank you to all of you for taking time to join us this morning. A special gratitude to the production crew, Fortress Media, and those of you that have given us live coverage, ZNBC TV1, Diamond TV, Prime TV, thank you very much. I'm told you also gave us a live feed. Mwebantu Media, thank you. City TV, Fan Voice Radio, thank you for broadcasting our briefing to Copperbelt as well as Central Provinces. Until next time, do have a blessed day.